As I said, most banks quickly changed their view on interest rates, saying the first rise will be coming this week. But money markets say that rates could rise 3 percentage points by the middle of next year. In other words, taking variable rate mortgages from around 2% now to 5% or more in 18 months' time. So let's bring in here Matthew Hassan, who is the senior economist with Westpac, who does specialise in housing markets. Matt, as always, many thanks for your time. This is one of the keys, isn't it? Because if you get rapidly rising interest rates, our economy is not going to perform in the way that maybe has been previously expected.
Oh, absolutely. This is going to be a significant jolt for our domestic economy, a significant tightening phase over the next 12 months, rapidly front-loaded in the next 6 months, and it's the consumer that's going to bear the brunt of that. And the housing market, the most sensitive, interest rate sensitive sector of our economy. That's going to turn things around pretty quickly. We think it's already turning. The softening's apparent in Sydney and Melbourne's markets. And as those rate hikes now come through and get more clearly signalled that it's a rapid sequence of hikes, then we expect the market, not just in Sydney and Melbourne, but across the wider country, to move into an outright correction phase for prices, demand moving lower and everything that comes with that. So it's a very challenging environment.
We'll get to that correction very shortly because I want to concentrate on that. But I know on Friday that Westpac has basically, as a result of these forecasts, of these interest rate rises coming much sooner than anticipated, you've recast your forecasts into the next 12 months.
That's right. The tightening cycle is now much more front-loaded than we expected a few months ago. It's kicking off in May. It's moving in rapid succession over the rest of the year. We think by the end of the year we'll have a cash rate around 1.5%. We're not quite as hawkish as the market, but we think 2% for the cash rate by about this time next year. So a very rapid sequence.
So let's think about that. So that basically 2 percentage points above means a person with a 2% mortgage now is paying 4% there.
Correct.
The markets are pretty much saying 5%, aren't they? So in other words, they're saying 300 basis points.
That's right. A wrinkle there is that a lot of the 2% mortgages are fixed rate terms.
Yes.
So they'll be resetting potentially much higher than that plus 200 basis points because the fixed rate markets have moved a lot further and variables are well above fixed.
So what about the outlook for Australia's economy then? Because it's forecast this year to grow very, very rapidly off the back of the reopening of the economy.
That's right. So we're sort of facing into this whipsaw this year and next. We're still positioned for very strong growth this year. The reopening, normalisation of activity post-COVID is a really big deal. We're saving, during COVID, we're saving 15 to 20% of our income. That's going to normalise to about 6%. We don't need we've got more opportunities to spend now. We don't need to do that. And that switching effect is going to flow through to spending, and we'll still see a very strong year for spending, though it's going to be capped or hosed down by these rate hikes. We think consumption spending will be about, consumption growth will be about 6.2% this year. Previously, we thought it was going to hit about 8%. But in 2023, once that phase is over, we're going to revert to sub-trend growth for the consumer. There'll still be a little bit of that delayed stimulus effect coming through. The $250 billion stockpile that consumers have mounted over the last couple of years will still help buffer against interest rate hikes, but the momentum will definitely slow right back to below trend.
Because the reality is that part of that spending is actually going to be on higher price goods. So in other words, people are going to spend more for what they currently get. So some of that savings is going to disappear as a result of the inflation and the higher interest rates.
Exactly. The dollar doesn't go as far as it would under a low inflation track. So one for one, that just takes growth off our consumption track immediately. And this year, we're looking at a significant downgrade just off the back of that, more than 1 percentage point.
OK, so let's now go to the housing market, because the housing market, which saw growth in capital cities of between 20 and 25% in the last calendar year, clearly that has maintained something of a momentum. But the question is, what happens when these interest rate rises kick in sooner than anticipated?
Sydney and Melbourne markets have started to drift lower in the first 3 months of this year, or ahead of, I think, in anticipation.
So what's your forecast then?
So, look, we think prices have peaked. That will get declines starting to come through from about June. And the second half of the year, we'll see prices down about 4% nationally, continuing that pace. 4% in the first half of next year, second half of next year, and then extending into 2023. But it should stabilise by about mid-2023. Peak to trough, we're talking about 14% decline in prices. It's comparable to the Sydney-Melbourne corrections we saw in 2017-18, but this time it's coast to coast. It's across the whole market.
So 14% fall is what Westpac is now forecasting over the course of this next phase of this cycle.
That's right. And because this tightening is front-loaded, it's coming through faster, and it's going to be mainly this year and 2023 that price adjustment occurs, rather than previously we thought the RBA would be still tightening to 2024. It's likely to be well and done by then, but it'll be a sharper, steeper tightening and a sharper correction phase for the housing market.
Matthew Hassan, always good to get your input. Senior economist at Westpac, Matthew Hassan there. Just interesting stuff about that housing market, hey?